So the role of real estate is being reimagined, and it really hasn't performed for some investors in the way that it was envisioned, because the concept that was evolved during the GFC of real estate being competitive with private equity and venture as a total return vehicle probably isn't going to work going forward that way. It's going to be much more of a diversifier. It's going to have much more of a stability factor. It's going to be more of a current return vehicle. And so you may see some more risk-off strategies, even from some investors who used to see it more as a total return. That is just what real estate is. It's realistic.
Nancy, great to see you. Welcome to the show.
Thanks so much, Brandon. Thanks so much for having me. I love your podcast.
Well, I'm excited for this conversation. For our guests that don't know you, can you just briefly introduce yourself and your company, please?
Sure. My name's Nancy Lashine. I'm talking to you from New York, New York, where I was born and raised. And I am the founder and managing partner of Park Madison Partners, where real estate placement agents started this from 18 years ago.
We're going to spend a lot of time talking about Park Madison and also picking your brain on what you're seeing in the market, especially from a capital allocation perspective. But before we do, as you know, I like to learn a little bit more about my guests. So you mentioned New York, kind of where'd you grow up? And let's talk a little bit about kind of how that informed your early years and how you found your way into the business and starting Park Madison. So maybe kind of give us the background, if you will.
I was raised in a place called Peter Cooper Village, Stuyvesant Town, which is, I think, well known now in the real estate investment business for a series of interesting trades, but downtown in Lower Manhattan. And I went to, had an incredible education. I went to an all-girls school. That might be an unknown fun fact, from 7th through 12th grade. Actually skipped 12th grade, went to college, have a Bachelor of Fine Arts in Dance and Theater, which was completely radical relative to the very sort of academic education I had before that, and graduated and I needed a job. So I worked as the technical writer in a batch processing computer services department of an advertising agency called Young and Rubicam. Actually, I decided after a couple of years that I wanted to become the short dancer in Paul Taylor's dance company. My father convinced me to go do anything else. And so I ended up applying to business school and I got an MBA, was the real estate teaching assistant. And that's how I ended up in real estate. How's that for serendipity?
There's so much to unpack there. Yes, there's a lot of serendipity. So why'd you skip 12th grade?
You had the option to when you were I was at a school called Hunter High School, and because you finished all your requirements. And I think we were all just anxious to grow up, get on with life. I was anxious to get out of my parents' house as the typical teenager. So I said, if I can leave home at 16, why not? I then dropped out of college after a year and a half because I was just too young, and I wanted to. This is another fun fact, not broadly known. I wanted to go work on a commune in California. So I wrote all these letters asking if they would take me.
Wow. Did you get it?
It seems so bizarre today. Of course not. Nobody even responded. But I ended up moving to Berkeley, California. I hung out at the Club Med Cafe and had cappuccinos or lattes or whatever, and ended up working at the waitressing at the Berkeley Faculty Club and teaching dance at the Oakland Y. That was my moment of not being in college.
It sounds like dance was something that was consistent and a passion of yours growing up. What were there specific types of dance that you were more focused on, or kind of what did that journey look like?
Ballet when I was in high school and modern when I was older, and back to ballet today because it's great discipline.
Interesting. So you dropped out of college, but eventually it sounds like you went back because you got a master's. So how did you what was the moment where you decided, okay, the commune wasn't going to work out for you, unfortunately. And, you were in the cafes in Berkeley. How did you decide you wanted to get back into the, maybe we'll call it more traditional journey on the professional journey?
Well, after I graduated college, I just needed a job because I needed to support myself. And my father owned the Park Madison coffee shop on 40th Street between Park and Madison. And so I said, gee, can you help me? Do you know anybody? And so he would ask his customers when they would come in to buy coffee in the morning. And I would get up, and this was the days of, rotary telephones. Or maybe I had a princess phone by that point. And, I'd start dialing phone numbers at 8 a.m. and see who would answer. And, went out for interviews and ended up getting a job in Young and Rubicam.
And so your first job was a writer at an advertising firm,
I was writing technical manuals on how to input. It was DOS, right? I was about the same age as Bill Gates. So we didn't have, Windows. So it was DOS. I mean, I didn't know anything. I was just kind of making it up, but you was enter here, do this, enter there. And so it was how to enter the information. And then literally there was a room with a bunch of women with green eye shades, taking the cards. I don't know if people know what batch processing is, but, and it was just bits and zeros and ones. Like you would tap the cards, think hanging chads in Florida, and that's how the information would be input.
Wow.
Anyway, that's how I started in the business world. Eventually, the person who ran the computer department had a bit of a Napoleon. He really wanted to become a profit center. So he wanted to sell the accounting systems or the different systems to the international. There were 46 international offices at the time. And somehow I got tapped because I had halfway decent French. And I was sent off to Paris to sell these systems to implement a system at that point. First to sell it and then to implement a system to the financial directors in the office. I mean, this is bizarre, crazy, right? And I realized business wasn't as boring as I thought it would be. So when my father begged me to go do anything else, I could, I was like, my sister's a doctor. I don't want to do that. Being a lawyer sounds really boring. I guess I'll be an Indian chief and go to business school. That's how I ended up with business school.
After the technical writer and you worked on kind of the sales implementation, that's when you went back to business school, or what was the sequence?
So then I went to business school.
Okay. And it looks like that was at Columbia, right?
Yeah, I had a rent stabilized apartment in Manhattan, which I did not want to give up. So I figured I could go to Columbia or NYU, and I got in and I went.
What a fascinating story so far. We haven't even got started. So you go to Columbia. Did you think you were going to be in finance, or kind of what was your intention when you finally committed to going?
I had no idea. I didn't even know, to be honest. I really did not know what finance was. When we called it baby finance, 101 finance. And I would sit there and go, oh, interesting. I found it so fascinating, especially accounting, that there were systems that tried to explain things and complete every box, because I came from a world, I'd studied writing and dance and history. And I came from a world where in philosophy, things didn't really have answers. There were more questions than answers. So I loved the fact that there were systems that gave you answers. And even though they were not sufficient, they didn't answer every question. They were sufficient for people. And that was kind of revelatory to me. And I felt like business was like a really satisfying place to be. Does that make any sense? That's the way I
it does. I mean,
it.
It's a fascinating contrast. I must say, you've listened to some of the podcasts. I think there's no consistent path that people take. So, I mean, this is just yet another example of a journey. So when you graduated, so you figured all this out, you're at Columbia and you graduate. What did you do next?
Oh, it's not like I had lots of options. When I graduated, I gravitated at the school to the people who I found most interesting. I found they were generally entrepreneurial, and the most entrepreneurial people were in the real estate group. And I became the teaching assistant to one of the real estate professors. And he would bring in all these different real estate practitioners over the course of the year. And so I took the course, and then I was the TA for the course, and he helped me find a job when I graduated. I was clearly not your ideal candidate for an investment banking job, but I did go to an investment bank. Because most people at business school, worked at a commercial bank for 2 years, went to business school, and then went back to go do something in finance.
How did your banking experience contrast to this like philosophy, dance, background that you had? I mean, you go from a world where there's no answers to where everything's clearly defined. And I can't think, at least stereotypically, of a more kind of rigorous, structured environment than an investment bank. I mean, was that a shock for you or were you ready for that change at the time?
I would distinguish between being a dancer is the most disciplined thing I've ever done. So you have a lot, it's like being an athlete, right? You have to warm up in the morning, you have to eat a certain way, you have to just live your life a certain way. And everything is a continuum. And it's all about awareness of yourself, awareness of your surroundings, awareness of other people. So it wasn't about the discipline. And it wasn't really, markets. The thing that was so interesting to me that I guess I focused on, I did real estate for the first 2 years and then I switched to corporate finance, that for various reasons. But I found markets were so unpredictable. I would be so fascinated. Every morning I'd read the papers and listen to the commentators saying, this is why the market did what it did yesterday. And then and you see what the market does the next day and it does something really different and there's always another explanation, but you realize that everybody was trying to explain things they couldn't fully explain either.
So during your career as a banker, talk to me a little bit about, kind of where did you work? What did you do? Kind of as you look back on that time period, how did, kind of what were some of the experiences that you had that kind of informed next steps in your career?
I worked for the first 2 years in the real estate group. At that point, it was largely tax-oriented syndications, which really weren't that interested. They were structured finance. And then uh, I switched into corporate finance because it was more interesting. And I ended up doing a lot of structured transactions because I had the tax and the structure background. Um, but that was really interesting because it was a firm called Rothschild, Unterberg and Towbin, doesn't exist anymore. But the firm was very much focused on initial public offerings, the IPOs of tech companies. So the firm brought public Intel and Tandem computers, and then we did biotech with Centicor and Zoma Logic, and I did a lot of structured deals for those companies.
Interesting. And it looks like you were there for about 4 years and then you moved on. Why the change?
Because after 4 years, I was let go. And that was probably the most, traumatic moment of certainly of my school or work career. Um, and uh, I decided to go back to real estate private equity was brand new. Um, and that was a really, I mean, it was a good growth moment. It's been so helpful to me in my own career as people come and interview for jobs. Um, just remembering how I found a job and what I did and how I got my self-confidence back after being let go. It was horrible, but it was great. And I ended up going to work for a company called, at the time, J.W. O'Connor and Co. Incorporated, which was a real estate investment, one of the very first real estate private equity firms.
What was real estate private equity at that point in time? You mentioned it was early days. Like what does that mean? Like what was going on?
So the insurance companies had some open-end funds that were strictly for pension funds. They were, typically structured as insurance company vehicles. There was no vehicle that would allow endowments and foundations. And so one of the first things that we did was create a private REIT. It was actually, I think it was the first UPREIT. And I remember sitting down with the man at Cambridge, Matt Lincoln at the time, and he said, "Wow, there's nothing for endowments and foundations in the market. The fact that you've created this vehicle so that endowments and foundations can invest is fantastic." And we ended up having Harvard as our lead investor and attracting a group of great endowments and then ultimately pension funds to that vehicle. So my job was to structure transactions, and then nobody else wanted to go out and sell them. That was what was what was interesting was doing deals, underwriting deals, and So I became the structuring and marketing and client service department of one.
Was this idea that endowments and foundations couldn't invest in these vehicles specific to real estate, or was this broadly applicable to alternatives or private investment opportunities at the time, or did those not even exist in any scale?
Yeah, they didn't exist in any scale. Alternatives wasn't even a term at that point. There was, ERISA had recently been passed, and so this was one of the first times that real estate that institutional investors could invest in real estate at all. Before that, it was really equity and fixed. And I can't remember when the first private equity vehicles came about, but this was 1980. 86 is when we closed the Retail Property Trust, which was the first one.
And so as this team of one going out there marketing this new product, I mean, do you like what did the market want, or what did they think of private real estate? And I'm kind of tugging on this because I feel like there's a parallel to maybe where we'll get, later in the conversation, where again at this like, critical inflection point in our industry where there's new types of capital coming into these vehicles, or newer types of capital. So I'm always curious to see what lessons we can learn from the past as we look forward.
Well, by the way, I wasn't a team of one. I mean, I was a team of one with that title, but needless to say, investors wanted to hear from, in this case, it was Jerry O'Connor, who had a reputation as a really good investor, a solid investor. So he had come from another firm which he had built over with some other folks over 10 years. And so I was his bag carrier, essentially, when we would go talk to investors. And I think it really, when I think back to those first days, it's like it is today. People invested because they trusted him. It was a relationship sale. I'm hard pressed to think of anybody who invested who didn't already know him from his past reputation. And it was a very focused strategy in that case. It was regional malls, which used to be, by the way, about 30 to 40% of institutional investor portfolios. You had office and regional malls. That's pretty much it. Maybe you had 5 or 10% industrial.
Fascinating. So you were at O'Connor Group for about 10 years, and then you branched out on your own. Was that kind of that's not a big step, but going from being an employee to being an entrepreneur and starting your own platform? What was that transition like?
Oh, I was not an entrepreneur by choice. While I was at O'Connor, I got married and I had 3 children, and I was commuting and I was traveling. We were building, having clients actually in the US and Europe at the time. And my life was just out of control, too much centrifugal force. So uh, I just decided that there had to be a better way. So I tried working part-time. That didn't work. But, realize this, I don't even think when I left there, we didn't even have Blackberries. We didn't have email. We had FedEx. So, you were in the office all the time. You were on the telephone if you weren't in the office in order to communicate. So we didn't have a lot of the tools that we have today to work remotely.
And so that period of time then, I guess, after O'Connor, when you had your own firm, I mean, but prior to Park Madison, it seems like you were doing kind of advisory and consulting work, or was that, were you also focused primarily on capital raising at that point in time as well?
Yeah. So my kids were young and my goal was to not travel as much. So I was the way I defined it was for my clients, I will help you with product development, client service, and the marketing effort, but I'll try to do it inside your door frame. So towards the end of the 10 years, I did start a placement business, which was also when I realized that, when I started to learn a lot more about the placement business.
So
it informed my next step.
I was going to say, so let's go there. So Park Madison, I think, was born out of that in 2006. If I have my dates right, is that about right?
That's right. Yeah. Good math.
So 2006, Park Madison, let's talk about where Park Madison is today? Like, what is it that you do, your size, your scale, your offerings? And then we can kind of creep backwards a little bit and kind of see how things have evolved over the last 18 and a half years.
So we're a boutique real estate capital markets business. We provide advisory services to our clients. Our clients are either real estate investment managers or operators. Um, and we are a bridge to them, from them to institutional capital. On the institutional capital side, we cover a really broad range of investors, from the pension funds, endowments, foundations, financial institutions, consultants. We also work directly with the investment management community. So our products are both funds and secondaries, recaps, continuation vehicles, programmatic JVs. We would be structure agnostic with respect to the product. We're based in New York, but we do have partners across the US. We are US centric, which is the broadest and deepest capital markets. I'm happy to talk about that and how that's evolved. And our business has changed a little bit it's changed a lot in the last 18 years. But we're a small firm. We have 18 people. We think of ourselves as half the people who come to work every day are partners of the business. So it's a very entrepreneurial place, and everybody is highly motivated, really smart, and really focused on making sure we're providing service and value for our clients. I mean, in many ways, we're a lot like, branding your business at Juniper Square. We are trying to provide a solution for a significant pain point in the industry, and that pain point being capital raising. Sometimes it is raising a fund. Sometimes it's knowing that you need to get distributions back to your investors, and you want to create a vehicle that allows you to take the assets that you have and create some liquidity for your investors. There's a whole variety of causality, but we're solving that pain point for our clients. And from the investor standpoint, they come to know us. I think, one of the things that just was clear to me early on was I wanted to build a brand. I think it's become a lot more important in the last 10 and 15 years in the world of social media networking. Excuse me. But I think our investors know that the amount of due diligence we do and how careful we are in bringing products to market.
When you think about the evolution of Park Madison, what did you expect it to be when you decided, you wanted to start this thing and, go back to work, presumably full time or maybe more than full time, and build a company, build a brand? What was it always focused on capital raising, or were there other problems that you were also helping your clients solve in the early days that, maybe you've evolved and gotten more specialized?
It's funny. I don't really think of ourselves as a business, as capital raisers. I think of we're investors, because we're investing our time, our team, our opportunity cost, and often our own capital. We like to invest our own capital in these transactions. We have a small amount of, also family office capital that we sometimes commit to funds. But we have a very steep funnel. We probably look at four or 500 deals a year, of which we might pick 12. So it's really about what does the market want to invest in right now, and who are the best in class managers that we can find, and the best opportunities that we can find to bring to the market.
I think it's fascinating because you talk about capital raising as a pain point, and I think most of our listeners, if not all, would broadly agree, especially those who have or who are trying to raise capital. But if you kind of take a more philosophical or academic view and say, well, if this was a perfectly efficient market, people who have capital and people who need capital should be able to find each other without any issue. You've been doing this for a long time. What are the specifics that make capital raising a pain point for GPs? Do you have, I mean, I'm sure you have a lot of perspectives on this, but like, what do you kind of, why is this such a critical problem that needs to be solved other than you need capital to run your business? But why is the act of finding the capital that you need such a challenge for so many people?
Oh, it's such a good question. Um, well, there's the market. The market is, it's a highly, highly competitive market. So there are many more opportunities than there are investors, right? There are many more managers looking for capital than there are investors looking for that opportunity. Most managers, when you get to the point of being good at real estate investing, it doesn't necessarily mean you're good at raising capital. You may not have the right person to go out and be a good marketer. You just may not know how to organize yourself to do it. And I guess the biggest thing is it's just a very broad and deep and changing market. And so how do you get someone to pay attention to you unless you already have a relationship with them? So even thinking in the last couple of years, it's clearly become harder and harder to raise a first time fund or to break into these relationships as the market has become more mature. But the first time funds that have managed to go out and be successful fairly quickly were all folks that had strong relationships with investors. They'd already made money for them, and they were, for a variety of relationship reasons, eager to back these folks.
So when you think about the conversations you have with the 400 or 500 GPs, but you're ultimately only taking on, I think you said 10 or 12 mandates at most per year, kind of what are you looking for? Like, how do you decide? What's the process that you go through to whittle down that, vast number of opportunities down to the ones that you really feel you can help have the highest impact on and make successful?
Yeah, I think, well, I would distinguish between the fund business and the capital advisory business. On the fund side, it's really important you have to do two things well. You have to be a fiduciary and you have to be a good investor. And you also have to know how to manage the whole process of the business, which is something that, Juniper Square has helped a lot of people with on the client reporting side, for example. But just 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 managing the business and communicating well is such a big piece of it. So so many folks just fall out. But where do we start? We start with, we're thematic. We start with, where do we think investors should be investing? And where do we think they want to invest in 2025? And then within that, what kind of returns um, are realistic to achieve in the market? And then does that manager who's come in and spoken to us, do they have a track record that speaks to that? Because without a track record, you can't raise a blind pool fund. Now, if it's a joint venture or a continuation vehicle, then you're talking to more sophisticated investors and they're underwriting specific assets. So the track record becomes less important, and there the pricing becomes more important of those assets.
This idea of track record has come up on other episodes and a lot of conversations I have, because I think the way that I understand it, and I'd love your perspective, is the track record that institutional capital is really looking for is an institutional track record, which almost definitionally makes it hard to get started. Like, you need somebody to give you that kind of first opportunity, because you can't get it's chicken or an egg and, constantly chasing your tail here. So, when you're meeting with these sponsors, these investment managers, these operating businesses, let's assume that, they've got the tools and systems and providers and partners to handle the operations of the business and that they can communicate effectively. That's table stakes. So let's assume we're only, keeping those in the mix. How should one think about the type of track record that they need, or the type of investing history that they need in order to be attractive to the capital providers that you have access to and that you know?
Yeah, I would broadly break it down into three different ways. One is they've gone out to the high net worth world or the retail world and raised a series of funds, but they've done that where they've retained full discretion. And there's, the track record's well done, and with retail money, you probably have to look at the gross returns, not the net, because they probably had a different fee structure, but that's how they raise the capital. A second way would be they may have a separate account with one investor, and now they're looking to diversify. So there is a track record with an institutional investor or two, but they've done it through separate accounts, but they have never done a fund, or they've had a fund, but it's not been broadly distributed and they want broader distribution. The key for that second category, and then this third category, which is doing a series of joint ventures where they were the operating partner with asset management firms, which is the allocator model, right? They were the operator in an allocator model, which is very common, is who had discretion on the buy and who had discretion on the sell. And if the capital retained discretion, then you have to get comfortable that that operator is able to make the buy and sell decision. And that's often a tricky aspect to the whole to our underwriting process. And then if we come to believe it, oftentimes some people just won't believe it until they see the second fund. So we probably, if it's a first time fund manager, we typically will say we'll only take on the fund if we're successful raising that fund, if we also have rights to raise the second fund, because we know we'll go out to lots of folks. We'll say, yeah, I kind of like the story, but I want to see the proof statement. And they'll come into fund 2, not fund 1.
So for investment managers or operators who are fit into one of these buckets, they've raised, retail capital or non-institutional capital in a fund structure where they have discretion. They've done or have a series of SMAs with, institutional partners, or they're the local operator in a JV structure, or the operator in a JV structure to an institutional capital provider, and they want to move into institutional funds. Kind of what's kind of the sequence of events or steps that need to happen? Because as you well know, I mean, this is a really tough market, and, ultimately one of the hardest things that I observe that GPs need to do is they need to get the attention of somebody like you. And you have a lot of opportunity. You have a lot of, you give a lot of your time. And I know you do a lot of kind of mentorship and coaching and giving advice, but ultimately you can only take on so many mandates. So how should, let's assume they're great investors, because there's a lot of great investors out there. Like, what are some of the other maybe less obvious things that firms need to be thinking about in their earlier days so that they can, be prepared to have institutional capital when the time comes, whenever that may be?
Yeah. So it's evolved. I mean, we've done 14 first-time funds in our 18 years, which I think is probably a lot relative to other folks. And fortunately, this is true. Every one of them has continued to go on and become a successful manager, and many of them are household names today, which is, it's like watching your kids grow up. It's fabulous. But today it's so hard to do it. And there's really only a handful of niche strategies where you can be, where a handful of niche strategies where we would take on a first time fund. There's also, as I mentioned, a few people who've been able to do it based on their relationships, but they typically wouldn't even need us in that case. What we generally tell those operators is, start with a JV, programmatic JV. So do you have in your history of the investments that you've made, some kind of portfolio that we can assemble that we can then take out and introduce you to the institutional market through that portfolio and start to build relationships? So you've now gone out and had lots of meetings. Lots of people have met you. You've learned how to tell your story. That's part of the service. And we've done a deal with somebody where they've now become your partner. Most allocators or all investors don't want to do one deal with one operator. They want to do, a lifetime of deals. Makes their life so much easier. And it's also proof that they picked the right operator. So nobody goes into it. Very, very rarely will someone go into a transaction thinking it's a one-off. So that becomes hopefully a programmatic partner for our clients over a long period of time.
You mentioned at the beginning, there's you're thematic in your approach. And then you just mentioned again, there's only a handful of niche strategies where you would take on a first time fund manager. So we can kind of come back to this theme of best practices for investment managers and operators, but I want to touch on some of the themes or the strategies that investors are most interested in right now. And we're recording this in early January of 2025, just to give our listeners some perspective, depending on when they're listening. But kind of from your vantage point today, maybe give me the kind of overview of what you think is going to be most interesting this year and for the next few years, if you have that visibility.
Well, where things have evolved is really focused on the niche strategies. So niche strategies affiliated with living and affiliated with storage. And that's probably broadly the two categories where most investors are interested today. So that you may have last mile industrial, but you may not have small bay light industrial. You may not have industrial outdoor storage, cold storage, self storage. Those strategies are still of great interest. Now, it doesn't mean that all investors want a fund that's just self storage. So, the niche has to be big enough, or the investor has to be big enough to have that make sense. But in there, if you look at just what's happened to the open-end fund, to the Odyssey rankings, they've taken a lot of the niche categories and made them bigger within the Odyssey fund rankings or fund descriptions. In living, it's student, senior, build to rent, manufactured housing, workforce housing. All those are aspects of multifamily that investors are interested in. And, I think, and we put this in our outlook this year, it's not going to be a V. It's probably more of a U-shaped recovery, but office is going to come back. Not an office index, but, certain office, because it's been beaten up so much. And so in office is only about 15% of investor portfolios today. It will, it will probably grow from there. And I guess I didn't say probably the most, the number one strategy for most folks today is retail, because it's been down so long, right? It's been almost 20 years of getting beat up. And so retail is a small component of most investors' portfolio today. Obviously, grocery anchored retail, outdoor retail has started to perform really well. The occupancy, the fundamentals are as good as they've been in a very long time. And when you have a vacancy, it gets filled up pretty quickly again. So we've looked at a lot of retail. Retail still tends to trade as a core plus asset. It's hard to find a value add strategy in retail. And a lot of investors are still looking for value add when they look at a niche strategy. So that's the needle we're trying to thread. But that's an area that's of interest to investors. And I'm saying it all backwards. And then the number one area of interest is data centers. And it's, a giant sucking sound of capital going to data centers today.
When we think about niche sectors, it wasn't that long ago where, real estate was considered to be, in your career, as we've discussed earlier, alternatives didn't even exist as a phrase. Then real estate came into the mix. Then it became alternatives. And there's a push now, to kind of redefine alternatives into just broadly kind of private markets. And then within that, there's kind of this transformation happening around, the return profiles from core to value add to opportunistic, and kind of where people are investing to get those returns. But, a lot of what we're talking about are niche. So does that imply that the reason that they're interested in they're the most interesting asset classes is because of the return profile associated with them? Or is there just something fundamentally interesting about cold storage or IOS or BTR that, investors care a lot about right now for portfolio composition?
It's a great question. And the answer is yes. It's both. It's both. Investors are interested because it's a diversification. They don't have it. But also because it's a newer, there's just a perception that there'll be much stronger rent growth. And so therefore higher returns in those sectors than in some of the more traditional sectors.
What's the biggest challenge with niche real estate as a institutional product type? And I realize there's a lot of like subcategories, but are there enough great managers doing it? Is it a big enough market? Are the portfolios big enough? I mean, I'm sure there's a lot of reasons why people, haven't invested yet or pass on investments that you bring to them. Like, what are some of the structural challenges when we're thinking about these niche or specialized asset classes?
Yeah, some of the structural challenges is it's too much of an operating business. So I did mention, for example, hospitality, which we also think is very interesting right now as a because of look what happened to hotels during COVID. So many of them have capital you know, disastrous capital structures, and they weren't well managed. And now, of course, everybody's traveling again, so they're seeing good fundamentals. But it's an operating business, right? And your tenant leaves every day, every night, has to check in again. So there's interest in that because you are going to get higher returns. But there's also the operating risk. You need to be sure you have the right manager, the right strategy. That would be true for cold storage. There's a lot of cold storage companies that people don't want to invest in. Obsolescence is also a big issue in some of these areas. I guess the other really obvious one is senior living as an operating business. Uh, Other impediments are, there are some sectors where we can't really find, they're just too small. The deal sizes are too small. The managers are too regional, and it's just really hard to scale it. So one of the strategies that is interesting for folks is this, you know, buy by the inch, sell by the pound. But buying small deals, putting together large portfolios, aggregating, and then selling to folks who don't have time to do that, and they're willing to pay whatever the basis point premium is in the cap rate to get the aggregated portfolio. And you'll see that with some of these strategies where the deal sizes are just smaller.
Similar to that, there's another trend that we've started to see over the last few years, which is consolidation in the investment manager space in general. There's, the big mega managers who obviously have a lot of capital and need to write big checks. And there's, a lot of small specialists, call them niche operators, managers that are really attractive to some of the capital sources that you're close to. And then there's a big middle part of the market that I think is, they're not niche and they're not the operators. Maybe some call them allocators, which means they raise from institutional and allocate to the specialists. Like, do you have a point of view on kind of the, some of these trends at the kind of the GP, operating, opco, topco level around, some of the consolidation that we've started to see over the last few years? Is that something that you've seen in your career? Do you think it's going to persist? How do you think about that trend?
Yeah, we think it's a huge trend. I think you'll see a lot of manager consolidation this year, and it will be it'll take years, but somewhere between 5 billion in AUM, and I used to think it was like 40 or 50 billion, but when I talk to some managers who are there, yeah, they feel like they're smaller. So especially with the barbell of the very large public companies that are building their own verticals. Um, by definition, you'll have a lot of consolidation. Um, and one of the trends that I think is interesting is, so you saw it started in the 90s, and you've seen it all the way through to today, the allocator model, meaning that you have an allocator and they invest in deals with a local operating partner. The local operating partner sources them, manages them, kind of runs them day to day, gets paid to promote, may get paid an asset management fee and gets paid to promote. And it's dilutive to the total returns of the fund to a pretty significant extent if it's successful. Um, you're seeing more and more the allocator model morph into a model where either the allocator buys the platform, which the very large folks have done, and they've bought big platforms, or they buy into a platform in order to share the GP promote. And so more investors are looking at kind of these GP style funds because it takes some of the real estate risk out of the trade and just generates gives them higher fees, gives them cash flow that's a result of fees that were generated by that operator doing JVs with other folks. So I think we'll see more and more of these hybrid models and more managers buying operators.
Is that something that Park Madison is directly involved in terms of from a transaction perspective, or more just something that you're tracking as a market participant that's happening adjacent to the work that you're doing?
We try to put our fingers in all the pies. Yes, we're involved.
I know there's a lot of managers right now that have portfolios that bought assets, kind of into the COVID period. And, we hear a lot about the deals are not broken, the capital stacks are broken, and there's a lot of groups out there looking to do portfolio recaps. Any kind of insights that you can share in terms of, the availability of capital for recaps, kind of how you're seeing structuring change given, the lessons learned, what, investment managers should expect if they're looking to recap a portfolio. And it's somewhat of a selfish question because every day I get, several questions from clients or friends or prospects who, have something that needs a recap. And I'd love to be able to direct them here to hear directly from you versus, hear from you via my interpretation of what you're saying.
Yeah, no, absolutely. And we'd love to talk to them. Maybe we're very focused on the recap business. There's a lot of capital available for recaps. What are the stumbling blocks? The stumbling blocks are the right property type. So it's hard to do an office recap today. It's just hard. It's hard to do a recap all equity. And so if you have retiring debt, at that point in time, it's really a question of pricing. Can you get positive leverage? And that's challenging, very challenging for most folks today. And from a property type standpoint, I would say the niche property types, particularly in the industrial space and the multifamily space and living space, are of great interest. Cold storage, super interesting. All the things I mentioned earlier. I think you'll see some data center recaps, which will be pretty interesting. Not the big hyperscale ones, but some of the smaller ones. So yeah, we love that space. We spend a lot of time in it. And the key is really you need to have a realistic seller, the right pricing, and the right property type.
One of the things that I know, you talked about in your 2025 outlook is kind of sustainability. And I think more broadly, I think it was framed up around climate risk and some of the challenges there. And, unfortunately, we're recording this as fires are ravaging through Los Angeles and many parts of Southern California, which makes some of these risks all too real and hit, all too close to home. But, insurance costs, climate risk adaptation, how do you think about some of these more structural changes that our industry is going through? And how do you think it's going to impact the way that investment managers think about their business going forward?
My heart goes out to everybody in LA as we're taping this. As we talked about earlier, it is apocalyptic. And I think it's been surprising to us. And if you went back and read our outlook from prior years, how long it is taking for the market to really price in climate risk. I think one of the aspects of that, obviously insurance is going to be a huge factor in that. And it happened probably 2 years ago now in Florida. We saw it definitely having an impact on pricing because insurance rates went up so much. But so many assets will become uninsurable, if you will. I think what's been hard about it is the unpredictability. So I remember a couple of years ago, we were working on a transaction in Miami. And one of the non-US investors who are way more sophisticated about this and ahead of the curve, if you will, in terms of assessing climate risk on their assets, said, no, I'm looking at a map and it tells me where I cannot invest. And I know this isn't Miami Beach. I know it's Miami, but I can't invest in Miami on the water. And this has just been part of their strategy for years now. I don't know that anybody was really saying Pasadena was off the charts. So it's the unpredictability of it that that may give us pause to figure out how this really gets implemented in strategies. But I would think the insurance companies and, and the lenders will take a lead in what they will and won't do, because obviously they bear all the risk and not the upside.
If an asset is uninsurable, is it investable?
Not for many of the investors that we talk to. Many of them will just say no. Um, I mean, this is a very, very, very big market, as you know. So if you're investing in a multifamily fund, because you've gone through your checklist and the manager seems like they're terrific, you don't necessarily know for a fact if they have insurance on every asset or if they have a blanket policy that's insufficient. You may have asked that question in your ODD, your due diligence process, but maybe you didn't, or maybe they changed their policy because now you've been investing with them for 3 funds. So at some level, it will be the manager's call, not the investor's call.
You mentioned unpredictability, and I'm going to get it so we end on a happy note. Don't worry. But I think one of the things that seems to be a trend is, I think you said in your report, survive until 25, and here we are. We're standing literally in 25, and but there's still so much unpredictability in the world, in the markets, interest rates, geopolitics, domestic, inflationary, trends that we're seeing. How should an investment manager, it seems like the trend is it's going to be more unpredictable than predictable. What advice might you have for someone who's trying to figure out how to operate in this new world order? Because I think life needs to go on, business will go on, but doing so, being surrounded by so much more uncertainty than maybe we were used to 5-10 years ago, poses its own unique set of challenges. Do you have kind of any thoughts on how to navigate this unpredictability that we're seeing?
Well, I definitely think we have climate change unpredictability, and we just lived through 2024, where in every Democratic election, the government moved, from one side to the other. So do you want to call that unpredictable, or just the pendulum has swung? When the pendulum swings, it always swings too far, and it will swing back. Now, this is not a conversation about climate change, because that is a risk that will not be correctable in a pendulum fashion. But I'm a firm believer in the human intellect and solving problems. We'll solve these problems, and we'll figure out how to manage better capacity to fight fires. And will AI help us figure it out? I don't know how we're going to figure it out, but we will figure out how to solve these problems. So I don't feel like we're entering into. I think for so much of life, when I think about, say, my father's life, he grew up. He didn't have TV, right? He didn't really have jet airplanes, right? You think about so many people, what the transition they've had to go through. So yes, we have to deal with political uncertainty. We have to deal with climate change. We have to deal with social networking and what all of that means. I don't know that it's that different than what prior generations have managed to deal with. But I do think that the role of real estate, to be a little more pedantic, in an institutional portfolio, is definitely transitioning right now. And it's partly that's because we've had for almost 20 years of wind at our back. And as rates have risen and inflation is now a true factor, when I graduated from business school, my first year as an investment banker, prime went to 21. And we all sat around and went, oh my God, do you have a job? So, I lived through mortgage rates being 14, 15%, and, watching how that evolved. But the market hasn't priced any of that in. So the role of real estate is being reimagined, and it really hasn't performed for some investors in the way that it was envisioned, because the concept that was evolved during the GFC of real estate being competitive with private equity and venture as a total return vehicle probably isn't going to work going forward that way. It's going to be much more of a diversifier. It's going to have much more of a stability factor. It's going to be more of a current return vehicle. And so you may see some more risk off strategies, even from some investors who used to see it more as a total return. And that is just what real estate is. It's realistic.
When you think about the balance of this year and maybe even the next year or two beyond that, what are you most excited about?
Well, I'm really excited about my partners and their business here. One of the really great pleasures I've had has been to be able to build this business and bring in other folks who now really are the business. And I just love working with everybody here, and it's just we just have a lot of fun. We have some amazing clients, and I'm excited to help them reach their capital goals and grow and get to the next level. Many of them have achieved fantastic success, and I'm looking forward to more of that because that's just a lot of fun. Um, so yeah, I think that's what's on my mind.
I love that. For any of our listeners who want to learn more about Park Madison, the services that you offer, want to get in touch with you or one of your partners or a member of the team, what's the best way for people to find you, to learn more, to connect?
Yeah, pop onto our website, parkmadisonpartners.com. Um, and listen, if you want, Brandon, I think you do an incredible job with your podcast. I love the guests that you've had, and you're really very good at asking questions. I mean, having been in this industry for so long, I'm amazed at how you can really just get right to the heart of so many of the critical issues today and in a very succinct way. We have a podcast that's called Real Estate Capital. We try to also bring some color from the people in the industry. And so that would be another way to kind of hear some of our perspective.
And I'm a big fan of your podcast as well. And I think what's really unique about it is the way that you featured a lot of perspective, but in particular, some of the most influential investors in the world who typically don't go on the record or, don't have a forum to share. So I would definitely encourage anyone listening to this to click over and, click onto your podcast as well. And we'll try to remember to link to that here in the show notes to make it easy for folks. So Nancy, I've really enjoyed the conversation. I enjoy the friendship and always enjoy hearing your perspective on the market. Congrats to you and your partners for everything that you've built at Park Madison. And I know, the work that you do for GPs in the market and LPs who have capital put to work is really, really important and highly valued. So thank you as always, and look forward to the next time we get to chat.
Brandon, it's always a pleasure to see you. You're terrific. Thank you.